welcome to STRAT this week. Will Woodall, Mike Rarey. Hey, Mike.
Hey, Will.
We are going to talk about the month of March and the oddity it was and all the things that happened, and look at the returns because as you look at March and Q1, it's been quite a journey so far. Let's throw the equity returns up on the board first and go through those for the month of March.
Yeah, the month of March, so that month-to-date column, the S&P 500 up over 3.5%, but it was all of the gains were concentrated in large growth stocks. So think big cap tech, FANG, MAGA, whatever acronym you want to use. Those types of stocks performed very well. Where you see the weaker areas of the equity market, they're primarily smaller, value-oriented areas, because that's where the heaviest concentration of the banking industry, regional banks in particular, are located. And some positive returns for foreign equities as well.
Mm-hmm. And so let's dig in a little deeper. What really led to sort of the big bounce in tech versus other areas of the market?
Yeah, good question. So, and we can show it sort of through this chart. That dark blue line, this is growth of 100 for the top 30 performing stocks during Q1 2023. And those were predominantly tech, consumer discretionary, communication services type stocks. And the first thing that you notice, so this chart goes from the beginning of 2020, is heading into 2023, they were extremely beaten down. Mm-hmm. If you were to look at something like the NASDAQ, down over 30% during 2022. Mm-hmm. And so they were very beaten down. They were heavily shorted. And the idea was that, the Fed is just going to keep hiking, and these companies, their cost of capital is going to keep rising. The liquidity environment is still negative. Oh, and there's a recession. And then immediately in January, we got the non-farm payrolls report that suggested, hey, we're definitely not in recession. And then some oddities within liquidity basically meant, hey, this sort of runaway downturn in liquidity is pausing. And then you had these technical factors where it was so many people were short, and now they want to cover. Mm-hmm. That combined with options, and there you go. And now the blue line for Q1 2023 was up 69%.
Right.
So those are your market leaders.
Yeah, and also some rebalancing from growth to value, or from value to growth, as it naturally happens. But generally, in terms of trends, is this a trend we see sort of, has the bottom been put in for the NASDAQ?
Well, something similar to this happened in the summer. You may recall we got into all these discrepancies between, is the NASDAQ in a bear market or is it in a bull market? And how do you define it? Because the NASDAQ is up 20% from its lows now, but it's still well below the December 2021 highs.
Right.
So in our view, that still would be called a bear market rally. You're still within a bear market, you are rallying. And then you think about all the reasons why tech and growth sold off in 2022, it's not like those things have gone away.
Right.
I mean, it's inflation running hotter than anybody expected for longer than they expected, and the Fed having to raise interest rates to combat that, and you combine it with slowing economic growth and really bad liquidity environment. I mean, that's still true. Mm-hmm. So that's why we would think this is more of a bear market rally than something that really has legs.
All right, let's look at the fixed income markets for the month.
Not a bad month for fixed income. Pretty much across the board. The only real exception there is high yield bonds month to date, slightly negative because we had high yield bond spreads widen out really since March 9th, which is right before banks started to fail. Right. But very positive month for long duration bonds, high quality bonds.
And in terms of the returns of bonds, was that a result of Fed action, or is it just market anticipation of future Fed action?
So that's very interesting, and we try to tease that out a little bit with the next slide. So, and this is looking at yield curves, and then we'll talk about returns. So this is the Treasury yield curves at different points.
Just for, they're looking less like curves,
yeah.
more like hockey sticks.
Yeah, for sure. So the first thing, all the way at the bottom, we start at the green yield curve. This is what the U.S. Treasury yield curve looked like on 1/1/2022 before anybody really thought the Fed was going to hike as much as they have.
Right.
And, these were simpler times, right? short-term interest rates were effectively zero. This was Tina, right?
Mm-hmm.
There is no alternative. And the yield curve had this nice upward sloping positive slope to it, and money was cheap everywhere. And then from January 1st, 2022 through October 24th, 2022,
right,
we went from the green line to the blue line. And that was really tough because you can see the Fed hiked rates, the short-term rates about 3%, and you can see how much the 10-year rose, and we started to get some yield curve inversions. And that was really nasty. I mean, when the yield on the 10-year goes up that much in that short a period of time, what you get is almost a negative 20% return if you owned a 10-year bond
right,
over that time period. And yeah, that was tough. And then what's around that time, our framework was signaling, hey, high and falling inflation. That's a good thing for bonds. And so within our framework, longer duration bonds start to look attractive, even though we know the Fed is still going to hike short-term interest rates. And, it didn't always look this way, but now if you look at the yield curve as of 3/31, the red line, what you have is you can see short-term rates did go up a lot still from October 24th through March 31st, but every other maturity on the curve went down, every other yield. And the 10-year yield went down quite a bit. And if you own that 10-year note, you returned, almost 10%
right,
in that short period of time. So, rising short-term rates does not necessarily mean it's a bad environment to own longer-term bonds, because eventually the yield curve starts to think the Fed has overdone it, and now the risk to longer-term economic growth and inflation have come down, and thinking, well, now sometime over the next 10 years, the Fed has to cut. And so that's where you get an environment where wasn't a bad time to own 10-year bonds or 30-year bonds or anything like that.
Yeah. Give us some, so it's great to look at this red line. So this is a severely inverted yield curve.
Yeah, this is
right?
as nasty as it gets.
Yeah, so I guess give some historical context on, one, has this ever happened to this degree?
Mm-hmm.
Perhaps two, how does this correct itself most naturally? Because the green curve at the bottom is traditionally what you see in a yield curve. Like this is your typical yield curve at varying levels, right?
Yeah. Yeah. So the red line, for some context here, in terms of percentage of yield curve pairs that are inverted, this is, roughly the most inverted curve ever. In terms of the magnitude of some of the inversions, you look at, for example, the difference between the 2-year yield and the 10-year yield. This is something like the second most inverted yield curve ever. It was only more inverted back in the early 80s. And so sort of use that to segue how this sort of solves itself, right? In the early 80s, why did the yield curve look like the red line? Well, because Paul Volcker was raising short-term interest rates aggressively to put the brakes on the economy to finally defeat inflation. And eventually that happened, and it happened through a recession. And so what happened, is the red line the longer term yield started to come down. And then finally, once, hey, we're in recession, inflation is defeated, the Fed finally got to cut short-term rates aggressively. But the cuts only came after inflation was defeated through a nasty recession, right? Which we think is a decent analog to what might happen here. Everybody's hoping on rate cuts. The Fed is not going to proactively be your friend and cut rates.
No.
They're going to cut rates if inflation is defeated, most likely through a severe economic downturn.
Yeah. I guess I asked the question primarily because it doesn't seem to be any easy way out of this curve inversion without significant pain somewhere.
Right.
I mean, either the long end has to go up considerably,
which is no fun.
Which is not going to be good for anyone. Or the short end has to come down aggressively and fast.
Yep.
Which means bad things are happening probably.
Right.
So this is, I guess the other thing is the duration of this. How long can this persist? Is this really meaningful that it's lasted this long?
The longer it lasts, the worse it gets. We're really seeing that now, where You think, so traditionally, if short-term rates are much higher than longer-term rates, you as a bank, that's a tough profit environment for you. But not if you pay depositors way less than short-term rates,
right,
than the Fed funds rate, right? If you can pay depositors nothing, then I don't care what the Fed funds rate is. I'll still make a positive net interest margin.
Right.
So given what happened in March, and it was sort of like deposit insurance and yield awareness month, banks are going to have to pay more for deposits now. In one way, shape, or form, eventually, this creates problems for banks. Sometimes it sort of happens all at once. Sometimes it's a slow drip, but it hasn't seemed to matter much yet in this cycle. But we think given everything that happened in March, it will start to matter much more going forward.
Yeah. So hot question of the day or week. Is the bank crisis, I don't even want to call it crisis. I mean, it's a mess, but have we seen this been put to bed, or is there still potential for this thing to blow up?
Perhaps the fireworks are over, but now it's sort of the slow burn afterwards, because the deposit migration continues, which creates very difficult options for banks. I mean, if you were a bank and say you have a large uninsured deposit at a regional bank,
mm-hmm.
there aren't too many good options here. So you're getting paid nothing and your deposit isn't safe, right? That's how it works right now.
Right.
So you go to the bank and you say, hey, I can go to a money market fund. I can get at least 4% more yield in most instances, and I know my money's safe because it's totally off a bank balance sheet.
Right.
Bank, tell me why I shouldn't move my deposit. And they say, well, you got me there. So you take your uninsured deposit, you move it to the money market fund. Well, now that bank needs to sell assets to fulfill your deposit. That's right. A problem, right? We saw what happens when that happens very quickly. Or alternatively, the bank says, no, stay here. I'm going to pay you more on your deposit. That's not good either. I mean, if the cost of all the uninsured deposits
curve, right,
goes up a lot, that's, exactly what the yield curve inversion matters, right? Narrower net interest margins, maybe they go negative. It's a problem. So that deposit migration is still happening. Just because we're not hearing of bank runs does not mean that we're not seeing a drain to liquidity,
mm-hmm.
less credit creation going forward, all those things.
Yeah. And so what are the knock-on effects of that? So banks doing that, how does that change their risk profile and willingness to generate and offer credit?
Oh, yeah. I mean, well, one is if deposits are leaving the door and you want to originate a loan, well, you need money to originate the loan. So if you think about new loan creation, it just stops.
Mm-hmm.
The other thing is if you have to sell loans to meet deposits and those loans or their securities are at a loss, that eats right into your capital. So now you need to go raise capital. They're just not good options, right?
You're stuck, right?
Yeah.
And in our estimate, what did we say? How much uninsured bank deposits are there right now?
Almost 8 trillion.
8 trillion
Uninsured deposits in the banking system.
So, if everyone was aware and smart enough, that 8 trillion could move into money market type funds.
Yep.
In very short order. What kind of what kind of impact does that have?
Yeah, it's tough to price it. I mean, if you basically assume that in one way, shape, or form, all the uninsured deposits in the banking system get some yield like the Fed funds rate. So, about a 4% higher interest rate.
Right.
That you just say 4% on something like 8 trillion, you're over 300 billion in sort of interest costs. Someone has to bear it somewhere. And, that's over 1% of nominal GDP. So that would be really tough.
So the other knock-on effect being it has sort of a implied tightening of the financial system.
Oh,
so,
yeah.
I mean, how does that sort of translate and help the Fed sort of slow the economy down?
Yeah. Well, you heard them mention this at the last press conference. Said, well, maybe a 50 basis point hike was more appropriate if you just looked at inflation. But because of what's going on in the banking system, that's going to result in tighter credit conditions. So we only have to do 0.25%. Right. What's not being understood there is, I don't think anybody knows how much actual tightening will happen in the banking system because of this deposit flight and migration and higher cost of capital. To say it's approximately equal to 1/4 of a percentage point of hikes, I just don't think you can do that, right? I mean, it could be. It also could be like 3% worth of rate hikes. We don't know.
Yeah, and I guess the last question, I know we're going on a little bit here. The last question would be relative to regional banks who are stuffed full of commercial real estate. How does that impact their ability to service those loans and refinance them as a historic amount of those loans are coming due in the next 24 months?
Yeah. So in the secondary market, if you're getting deposit flight, your regional bank deposits are leaving, you need to sell assets, you have CRE loans, well, you have to sell those loans on the secondary market. Who's going to buy them if every other regional bank is going through that same process, right? So those just get marked down, and you have to take a mark-to-market loss. And then, you know, say there's about $2.5 trillion worth of CRE loans outstanding in the U.S. ballpark, and about $500 billion is going to come due in each of the next 5 years. Well, when that $500 billion comes due this year, who's going to roll that over? You know, that loan will come due, and the principal will be repaid. You know, it'll be a good loan, but who's going to sign up for that again?
The next round.
Given that they're losing deposits. So that's where it becomes a problem.
Yeah.
And the market will clear, but at what cost? You know, now a bank will say, oh yeah, I'll do that loan, but fully collateralized, 8% interest, make up some number, way higher than market rates right now.
Which puts a huge burden on that as they're searching for tenants to fill their buildings. Okay. All right, let's move on to alts for the month.
We're only on alts.
We're only on alts.
Let's go.
How much fun are we having?
So, difficult month for alternatives. One in the global real estate sector, down 8%. I mean, anytime there's disruption in the banking system, we just talked about sort of the pass-through effect to real estate, so that was difficult. And then commodities, a month that you typically see when recession risks rise in terms of, you know, negative for energy, positive for precious metals. And then, of course, you know, OPEC Plus does a surprise production cut today, so this will reverse probably when we do the shoot next week.
So since you mentioned it, what is the OPEC cut impact short term and then sort of next 3 to 6 months on inflation? Like, how does that? What is the magnitude of any impact like that?
So it pretty quickly flows into headline inflation, and then over an extended period of time trickles into core inflation. But I think more importantly is it looks like the powers that be are saying, hey, it's roughly an $80 floor on Brent. So if you think at anything south of $80, there are going to be production cuts. Well, how are you going to get inflation down if oil's still running at $80, you know, minimum $80 a barrel? So that definitely has knock-on effects.
And that flows through to the economy then in goods production and gas and all these other things down the road.
Sentiment, lots of sentiment. Everybody's sentiment is tied to gas prices, right?
You know, everyone loves gas except Mike. He drives a Tesla.
That's right.
All right, so let's do an update on our liquidity real quick.
Yes, and so the February money supply number came in. So you see that as the dark blue line going down even further. So we keep saying this, new record low liquidity year over year. We had to retrain our model because there has never before been a negative year over year M2 print. And so we've retrained our model, reconfigured our forecast given the Fed's Bank Term Funding Program and its increased usage by the banking system. And what you get is it looks like money supply growth year over year is going to be negative probably at least until Q4 of this year. So really tough.
Yeah, long time. And again, just to, in case you missed our prior versions on this, what does the Fed program impact on liquidity have to actual market prices for stocks and bonds and things?
So it shouldn't be long lasting because yes, they are Fed assets. Fed assets are going up. And just blindly say, hey, Fed assets are going up, I'm buying risk assets, right? But this is different. These are emergency loans to banks to plug holes and they're short term, as opposed to the Fed coming out and saying, I'm going to buy X billion dollars worth of treasuries and mortgage-backed security every single month until the economy is recovered. That is something that makes you want to buy equities.
Completely different. We're
totally different.
Longer term versus a 1 year period, right?
Yeah.
And then in terms of net liquidity, how that obviously brought our fair value closer to where it is today.
For sure, yeah. You see the first off, when we were talking about how net liquidity, even though the liquidity picture is bad, the net liquidity year to date has been meh, which is enough to apparently was enough to sort of put a floor under growth assets for Q1 a little bit, right? But you look at the factors at B here and you think, where's that green line headed? Well, it's Fed assets, which we know the Fed is still rolling down their securities portfolio, $95 billion a month. So that would force that number down, minus reverse repo, minus TGA. So reverse repo is probably going to get bigger because a lot of money is moving out of bank deposits and into money market funds. That money has been taken out of the banking system. It cannot be used to create any more money. When it gets parked in a money market fund, what does that money market fund do? They reverse repo it. They lock it up. Take the liquidity out of the economy, it becomes useless, right? So that would force the green line down. And then the last thing is the TGA. It's tax refund season. The TGA has been drawn down south of 200 billion from 500 billion. So when the TGA gets drawn down, green line goes up. And then once tax refunds are paid, it gets replenished. And then TGA and there's the debt ceiling thing. TGA should start to be replenished, so that would put downward pressure on the green line as well. So going forward, the net liquidity floor, we think, will sort of no longer be there.
We've been talking a lot about economic growth internally and sort of the range of forecasts for Q1 GDP. I can't remember being this wide, this late in the cycle. I mean, we're in April, and there's still a 4% lane of difference between GDP estimates. So where are we shaking out for Q1?
So for our framework, we measure real GDP growth year over year. You see 1 year out, 71 basis points is the forecast. That assumes 2.5% growth in Q1, which is on the higher end, but it's right in line with the GDP Now forecast, for example, from the Atlanta Fed. So that's pretty rosy. So what we think is most likely to happen is there was some economic impact from what happened in March. Those March data points, which will count towards Q1 GDP growth, that data won't come in until sometime in April. So it's likely that our Q1 estimate is going to get revised down probably right until the actual first official number is printed, late April. And what will also happen is our full year forecast will probably start to come down as well, because we don't think that's just going to be, hey, growth that's recovered later on in the year. And as it sits here today, that 71 basis points for calendar 2023, all of that is Q1 basically. 2.5% annualized rate, you unannualize that, and there it is. I mean, that's basically it. So if Q1 comes down, then and then you think Q2, Q3, Q4, it's roughly flat at best.
So the party's over. It's time to start drinking water, and you can drive home safely.
And buying bonds.
Buying bonds.
Or cash.
Or cash, yes. So I guess the question I would ask with respect to sort of the forward-looking economic growth assumptions, what are the biggest outliers in terms of what could change and how quickly could it change? If we're suggesting pretty much flat for the year, like how quickly can that change in either direction? Or how wrong could we be? Is maybe a better way to ask the question.
I think we could be pretty wrong. I think everybody could, right? Because you look at Q1, for example, coming into Q1, the consensus was right in line with us, which was, hey, all you need is a little softening in the labor market. The economy's slowing enough anyway that it's probably going to be a negative print, and we're going to get something, with a two handle on it, most likely.
Right.
So what's sort of not being, what can be underestimated, and it has been underestimated this entire post-pandemic cycle, is even if the rate of change of money supply growth is negative, there's still so much money out there that can just be recycled through the economy, right? It starts out, the Fed creates it, the Treasury creates it, and then it goes right into people's checking accounts. That money gets spent, and then, you know, businesses hire people, so now that money turns into wages, and then those wages turn, and you get this flywheel, right? And this is what happens in monetary inflations, right? It's hard to say exactly when the flywheel is going to just stop. So you could be really wrong sort of in either direction.
Yeah. And I guess just anecdotally, I've been listening to a lot of conference calls on earnings and revenue guide downs by companies recently, just in probably the last 2 weeks. Not just small ones, like significant guide downs. So suggesting that potentially we're overestimating what earnings are going to look like.
Oh, yeah.
So potentially having an earnings recession.
Right.
And then how does that maybe translate into a credit event?
Yeah.
Like, when do we stop worrying about an earnings recession and start worrying about some of these companies actually disappearing?
Well, yeah, because historically, that's what breaks that flywheel we were talking about, is personal incomes need to fall. How does that happen? People get unemployed. They become unemployed. And, you know, if earnings are taking a hit and that results in higher unemployment, the flywheel breaks. Now you're trying to roll over this mountain of debt, but the money isn't getting recycled anymore. So those wages aren't turning back into revenues anymore because the income stopped. Then yeah, I mean, you definitely see bankruptcies for sure.
And that is sort of the tip of the spear in terms of real problems.
Yeah.
You can really start to see some drawdowns in the market when those start to happen.
Yep.
All right, so we touched on inflation. Let's give an update because I think we still see it persistently high here, well above the Fed targets.
Yeah, the core number, you know, we still think it'll be running above 4.5% for the next 12 months. So, you know, we're excited to see the March print for inflation, but you know, a lot of this is services inflation. A lot of it is shelter, which, you know, we think shelter should start to come down, particularly because new rents are coming down. And existing rents sort of, you know, they'll catch up to where new rents were. But still, if you look at services ex shelter, still running way too hot, way too hot. Fed knows that. That's why they had to hike at the last meeting.
Okay. Yeah. Anecdotally, also, you're starting to see significant price cuts on housing, especially in the Florida, Arizona, Texas areas where people flock to Nevada. All right, and then just last but not least, our recession update for the month.
Recession forecast came down, and
there you have it.
Right. So why does that happen? Well, if we look at the indicators, first thing you'll see, if you look about halfway down the page, the S&P 500 as a percentage of its 52-week high, short medium indicator, went from red to orange or yellow. I think that's supposed to be yellow, but it looked kind of orange. But yeah, we went to a yellow light because of the strong market rally we had last week.
Yeah.
So, you know, that's good news in the near term. And then you look at something like heavy vehicle sales. Well, heavy vehicle sales were pretty depressed last year, and now we're looking at year-over-year change. So it's becoming much easier base effects. So there's also here a lot of these year-over-year indicators. There's sort of a natural, very small decay that happens because of the base effects, because they've been, you know, in a drawdown for a year or so. But you look at the other things, New York Fed recession indicator keeps going up, Cleveland Fed recession indicator keeps going up. Things like the conference report, LEI, housing starts, high yield bond spreads are still wide. So still elevated, just a little more tolerable than last week.
Which is not abnormal in terms of how these things play out. There's volatility to these. So we'll definitely keep our eye on this. And thanks for joining us this week. Looking back at the month of March. If you have any questions, please reach out to us or contact someone at the Private Wealth team. We're always happy to talk about our framework and our outlook. And till then, we'll see you next week.